Our next guest says we have arrived at an important cyclical turning point, and he sees the market broadening, though perhaps not booming from here. Joining us now, Michael Kantrowitz, Chief Investment Strategist at Piper Sandler. Good to see you. Welcome. So broadening, in what respect? I mean, are we going to finally see sort of the earnings growth catch up from the average stock, or is it just going to be kind of a rotation of flows? How do you see this playing out?
I think it's more about a breadth story than a magnitude story. So both from a macro and micro perspective, we've had these great 3 years in the market. You've seen housing data have this L-shaped situation for the last 2.5 years. Same thing with manufacturing. PMIs have just been stuck, not going anywhere. And we see now we have the beginnings of a improvement in both the macro economy, which should translate into a broader participation in earnings to the upside in the market as well.
What drives the broader economy in a better direction? I mean, there is this reacceleration thesis, people putting the pieces together of, you do have some of the tax provisions kicking in. Yeah. I guess just kind of, going that long without, seeing much growth from housing and manufacturing, you're going to get a little bit of a benefit from just comparisons and things like that. But is there anything else going on?
Well, it's been way long enough to hope for those easy comparisons.
Yeah.
I think it's more than that. I like to think about something changing as well. Why was it in a bad spot in the first place? And clearly, interest rates were an issue for smaller businesses, for lower-end consumers, for housing, for manufacturing, which was impacted by housing. So it's the fact that we've had rates that have been stable for 2.5 years now. Everyone's been debating where the 10-year's going. Yeah. It hasn't gone anywhere. And we're at the low end of the range, and the Fed's cut 125 basis points. So just the fact that we're not seeing rates go up and have stabilized and have now started to drift down makes all our anticipatory indicators pop up and look like a green shoot.
What does a broadening market look like? Because when you say broadening, most people think, some sort of a handoff from technology to other sectors. Does it necessarily have to be the case?
Well, I think it's more joining. I don't see this as a big rotation out of tech. Large cap growth, the NASDAQ have dominated really for 10 years, not just the last 2.5, 3 years. So I think it's the more, the door is getting a little open, the bouncers letting some more people into the party perhaps. And again, I think it's ironically due to the fact that we have a soft labor market, which has allowed some of the inflation fears to come off and allowed interest rates to come down, the Fed to cut.
Yeah, it's an interesting dynamic. I try to point this out. I mean, there was a time in like May or June when you had Powell saying data dependent, wait and see, we're not ready to cut. Yeah. And he was pointing to the unemployment rate, right? We're at our mandate there. We don't have to worry about it. And since then, because of the softening of the labor data, people are making the case, or at least have the impression, that maybe that's overstating the weakness in the underlying economy and therefore giving the Fed room to cut without necessarily the pain of actually a downturn.
Yeah, as long as it's balanced, which I would argue it has been. It hasn't been a negative surprise. It hasn't been a swift move up in the unemployment rate. That's a really good backdrop. That's Goldilocks in a post-inflation shock world. And you have to go back pretty far in history to see past periods where, just like today, the unemployment rate and the stock market went up together, which they've been doing for the last 2.5 years.
In terms of tariffs and sort of the uncertainty, because Trump will say 100% tariffs on films not made in the United States, tariffs on furniture now.
Yeah.
It may not necessarily happen, of course. These are sort of headlines that we're dealing with right now. But in terms of just market uncertainty, I mean, does that feed into it at all? Or are we just so inured to these threats of tariffs that it's fine, we look through them?
There's just this huge, I think, diminishing impact of fear and the wall of worry. And, we've climbed the largest wall of worry in the history, probably in the last 5 years. And so even something like the shutdown or these more industry-specific tariff situations, I think investors have gotten to a point, whatever the fear is, will show me first, and then I'll react, which is generally, I think, how the market behaves. But it's even more clear, I think, in the last couple of years.